All right, joining us now, Scott Martin, Kingsview Wealth Management CIO and Fox News contributor. Scott, great to see you. Okay, so Jackie was talking about the recessionary camp. EJ says, I think we might backdate a recession to about right now. You're playing this from a market standpoint. How are you thinking about recession and where you're putting your money?
I don't see one. I haven't seen one for the last 2 years like many of the experts have, Brian, and I don't think we're going to get one. And so, look, and these are the same people, and not so much EJ, but some others, Brian, that told you to get out of the stock market because the recession was coming, and it never came. The corporate debt bubble was going to explode. It never came. It never blew up. So, look, I think there's a lot of fear out there on days like today when you see some bad numbers as far as tech stocks go. But these are stocks that have rallied so hard this year and been so accretive to bottom lines in our portfolios, especially stuff that we've owned. You've got to have these pullbacks to get these weak hands out so you get the strong hands back in. And yes, we've got a big Fed meeting coming up later this month. I don't think they should cut rates. I think they need to leave everything the same. I don't think the economy is bad enough to support rate cuts here. So if they stay steady, I think that's what the market should want, and I think that's what the market needs.
Ooh, that is not what the market wants. The market, Scott, does want to see a rate cut next week of 25 basis points. But having said that, I look at this and think to myself, so is today a day where investors who have made a lot of money in tech are just profit taking? Or is this truly a day where bad news is bad news and the selling will continue? Then you sort of look at the backdrop of September historically being a weak month for stocks as well. To your point, you've got a group saying, we're in a recession, things are really bad. Maybe others would say, you know what, this is just par for the course.
Yeah, and the S&P is coming off all-time highs, as is the NASDAQ. And so that was, a few weeks ago. And yeah, sure, we're off those, which people are going to say, oh, now here's the recession we told you about 6 times in the last year. And Jackie, I got to be honest with you. I mean, is it really bad data today? I mean, the data didn't seem that terrible. And frankly, if you look at the overall Fed speak here, the market, I think the media wants, frankly, a rate cut. I don't know if the market does. The market has already washed away about 100 basis points in the 10-year, and that has already kind of laid off, or at least laid low, some of the mortgage rates that everybody was screaming about in the housing market. So the market is kind of taking care of some of the Fed's work here. And frankly, think about it this way, guys. Let's say we do get a 25 basis point cut here before the election with a growing economy, with an economy that's adding jobs, with wage growth that's now increasing, with an unemployment rate that's at 4.2%. What are we going to do after that? Are we going to keep cutting rates into, say, 3%, down to 3% because the market says that we want this? I mean, that's where the Fed gets into this tough position where they're going back and forth to kind of assuage what the market seems to be telling them, when in reality, if you look back at data 10, 20, 30, 40 years, the markets and economy do the best when the Fed is off the front page. And so if the Fed can just be out of the way for a little while and let things marinate, I think that's going to be the best result here.
It's hard when we're all addicted to zero interest rates, Scott. Pivot with me and come and take a look at some of the new data that we put together. Goldman Sachs, some of the latest, that's putting out some startling estimates regarding market performance and tax proposals of both presidential candidates. So, Scott, on one hand, Donald Trump's plan to cut the corporate tax rate down to 15% from the current 21%. He's saying that would boost earnings by about 4% on the S&P 500. On the other side of that, Goldman's saying that Kamala Harris's suggested increase up to 28% of the corporate tax rate, it would actually reduce earnings by 5%, as close to 8% when you factor in other taxes. Is this a market that is appreciating some of the benefits or the risks of these plans come November?
I think you got it. I think that's exactly what's going on here. And shocker to think that would be the case, Taylor, as you dug through those numbers there. Very well done. And of course, too, don't forget just that on the surface as far as the impact on the market valuations, and then the wealth effect that gets stacked on top of that, Taylor, with regards to what the market behavior does after, say, those policies are enabled, whether it's Trump or Harris, and how that affects, say, the Americans' well-being as far as how well we feel, how well the consumer feels after things like that. Because that wealth effect, that pile-on effect that the stock market generates, whether it does poorly or well, is something that does come out in stock prices. It does come out in the economy, and that's something to be very wary of as we go into November.
Scott Martin, you are bringing a heck of a lot of fight today. I love it. I hope a little bit of that fight can carry over to our Vikings this weekend against the Giants.
We've got the Giants on Sunday, Brian, and that doesn't look too good. So I got to bring something while we still can control it.
I think we need you on that offense for the Vikings, but that's for another day. Good to see you, sir. Thanks for being with us.
See you.
All right.